Hi, my name's Roy Thompson. I head up MHA Carpenter Box Financial Advisors. Today, I've got with me Henry Wilson. Henry, good morning to you. Henry's an investment manager at LGT Vestra. So thanks for joining us today, Henry. When we've spoken, the last couple of ones of these sessions, we've looked at inflation. I think if we went back a month, there was some concern about potential spike of inflation, increase in interest rates, and that kind of impacted on investment markets. Actually, since that dip in sort of end of February, beginning of March, investment markets, certainly in westernized economies, major economies, markets have gone particularly well. I don't know if there is any particular reason for that you would cite, Henry.
Yeah, so I think one of the things that had really spooked the market was the rate of change in terms of where they felt that interest rates were heading towards. And it's not so much the overall direction. They felt that the rate of change was moving in too quick a direction. So with inflation numbers coming through very strong and the potential for an April and May inflation print to be very high, there was concerns that all of a sudden the trajectory of those interest rates would be moving quicker than previously anticipated. Now, the rhetoric from central banks and sort of governments has been really that this loose monetary and fiscal policy environment will continue for some time. So they've kind of pushed back on those concerns, and that's buoyed the market further. The other things that we've seen is that sort of continued successful rollout of the vaccines. Clearly, there's been a little bit of concern around the AstraZeneca vaccine and the blood clots, but when we look at it sort of in the detail, we believe that the rollout will still continue very strongly. It's a very kind of slim reality that only a very small amount of people might suffer from these blood clots. So we don't expect it to really materially impact the rollout of the vaccine. Likewise, recent weeks in the US, the agenda has really shifted towards the fiscal package and fiscal stimulus that you might get there, particularly looking at things like the infrastructure projects. So the market is really buoyed by that. They like the fact that you might have this, it's called a fiscal multiplier effect, where sort of for every dollar that the US government puts into fiscal expenditure via infrastructure projects, they get around $2 to $2.50 back via things like taxation and spending. So, if you're in an infrastructure firm, you get a construction firm, the state pays you, you go and employ people, the people get their wages, they then go and spend it down in the pub or they go on holiday, whatever it is. So I think one of the things is that the market's gone through a period of sort of digesting the start of the year and these inflation figures that were coming through. And they were, as I said, concerned about rates going up quicker than previously anticipated. And it's now had time to digest that. It's calmed down and things are kind of smoothened out. Mm-hmm. US 10-year yields at around 1.68 today. We don't think the pain trade, i.e. the level at which investors get really concerned and start to switch into risk-free assets, we don't think we'll see that until around the sort of 2.5 mark. So probably not until later this year will we see any kind of material shift in investor appetite towards equities. I saw some information today that in the last 12 months, more money has been allocated towards equities than in the previous 5 years altogether. Wow. So investors are really shifting capital into equities. It's a meaningful sway. And so long as money is still heading in that direction, we believe that markets will still be quite nicely supported, mm-hmm. Particularly with this fiscal and monetary stimulus that we're seeing from central banks and governments.
Mm-hmm. So yeah, that sort of information is quite powerful, isn't it? When you start to see that sort of quantum of capital shifting towards investment markets or equity markets. So I guess in my own mind, the Asian markets have not caught so much of that continued rally, shall we call it, in the last month. They seem to have lagged a little bit behind westernized economies. Any particular reason for that, Henry?
Yes, so I mean, one of the things to note really is that obviously Asian markets and China had a very strong 2020. So in relative terms, they just haven't been quite as exciting as sort of some of the Western economies and their markets. But they had a very strong 2020. And in recent weeks, it potentially hasn't been as strong, but they weren't coming from such a lower base. So take somewhere like the UK, we had a very strong lockdown in terms of the restrictions were very firm. And so we're coming off this low base of a cratering of GDP numbers, a cratering of economic activity. And we're now having upside surprises. So, people's expectations for earnings growth are being re-rated upwards. Yeah. Whereas in China, they didn't have that same level of lockdown. So they've been trundling along at a sort of more normal pace. Likewise, they haven't had to go through the same sort of measures from a monetary or fiscal perspective as we have in the West. So they've still got kind of money in the tank, as it were, if they do need to stimulate the economy. But it's all relative here. They've just had a slightly less exciting period than us, but we were coming from a much lower base. From our regard, Asia and China sort of still remains the future engine of global growth. So taking a sort of 10, 15-year view, we think that's where the global economy is heading. And it was really interesting to see Boris Johnson talk up Asia the other day and sort of try and steer away the UK from Europe and recognize that actually Asia is the growing part of the world. It's, demographically, it's a much stronger region. So yes, not altogether so exciting for the last 4 months or so. And the news today of Alibaba and the regulator getting involved is something that we'll keep an eye on. But I think it's 3% of Alibaba's cash that they'll pay away to the regulator. It's not much, but it's worth looking out for. But we still think that it's the home of some really fantastic companies. So outside of the US, where the US for us probably has the highest quality tech companies, then you look towards Asia and China, and you really see some other fantastic companies there, and that's where we think that will just continue for some time now.
So still a positive medium and longer term view, but if we just looked at that very, very short term, the last few months, what you're saying is performance hasn't been as strong there because it was stronger in the preceding year as an overall. It's moved forward quite positively. And I'd guess here in the UK, it would be interesting now, won't it, to see how, off the back of more things opening up, here we are, April the 12th, and things start opening up. Hopefully that's good for economically moving forward. I certainly am looking forward to getting my hair cut and making my general appearance look better. That's for sure. Without further ado, I'll just left to wrap it up for today. But Henry, thank you very much for joining us and sharing your thoughts. Appreciate that.
No worries.